Wheaton Precious Metals just generated $750 million in cash in exactly 90 days. Welcome to Earnings Unscripted. Today is March 13th, 2026, and we are looking at a truly massive Q4 2025 from Wheaton, ticker WPM. I mean, revenue is up 82% sequentially. Mira, what kind of quarter is this even?
It is literally a record everything quarter. The outgoing CEO, Randy Smallwood, said exactly that on the call, actually. The headline numbers here are almost hard to process. You have $864 million in revenue and an operating cash flow of roughly $746 million. That is nearly a 95% jump from just last quarter.
Which is exactly why I should probably remind everyone right now that we are just two friends sharing personal opinions. Please do not take any of this as financial advice, because those numbers sound like a late-night infomercial, but they are just real life. How do you even double cash flow in 3 months without printing money?
You lock in your costs while the precious metals market goes parabolic. Look, just a quick reminder on what they do for a living. Wheaton is a streaming company. They do not run the bulldozers. They give miners upfront cash to build a mine, and in exchange, they get a fixed amount of metal at a locked-in price for the life of that asset. So right now, their average cash cost for an ounce of gold is $495, and the realized price they sold at across their portfolio surged to over $4,500 an ounce.
Jeez, you just collect the spread.
Exactly. When volume spikes, nearly every extra dollar drops straight to the bottom line. That brought diluted earnings to $1.23 a share, up 52% sequentially.
Okay, so wrap my head around the stock price then. The tape was it was grinding up really nicely late last quarter. But heading into these earnings over the last couple of days, the stock saw a pretty steady multi-day sell-off. It just kept dropping until it finally bottomed out right at the start of the earnings call near 142. If the quarter is a historic record, why was the market dumping shares right before the bell?
Because the market knows the volume spike was partly a statistical freak event. That is the word the VP of Investor Relations basically used on the call. They had a massive flush of what they call produced but not yet delivered inventory, or PBND.
Right, metal that was stuck in transit.
Exactly. Mostly out of the Salobo mine. They hit a quarterly record of almost 89,000 ounces of gold there because of a sudden logistics unwinding. So a ton of metal that was sitting around in transit suddenly hit the income statement all at once.
Got it. So it's essentially borrowing a bit of glory from the surrounding quarters.
Right. Expect that to reverse in Q1 when the shipping dynamics normalize. But honestly, the bigger story is how they're choosing to use all this cash. During the Q&A, the CEO went on this amazing rant about how they refuse to hold quote-unquote lazy cash on the balance sheet. They're about to close a $4.3 billion silver stream on the Antamina mine next month.
And they're not issuing new shares to do it, right? Which in the massive mega mine space is basically unheard of.
Yeah, zero dilution. They're taking on about $2.4 billion in net debt instead. They literally called corporate cash storage a lazy strategy, which I kind of love. It's aggressive, but it's highly efficient capital allocation.
All right, let's actually get into the details on that Antamina deal because the terms are fascinating, and I want to see how that debt load changes their risk profile.
Right. So to answer the risk question first, it actually doesn't change their risk profile as much as you might think. The VP of Investor Relations, Emma Murray, was pretty clear that they do not ever want to introduce real credit risk into the company. They are comfortable running at, I think she said 1.5 to 2 times leverage, which is very manageable when you have a direct line of sight to $10 billion in operating cash flow over the next few years.
Which implies they can pay down that $2.4 billion in debt incredibly fast.
Exactly. The CFO actually expects them to return to a net cash position in roughly a year. But the real magic here is the asset itself. Antamina is a generational silver asset for BHP, and Wheaton secured this stream with zero buyback clause.
Okay, but explain the buyback mechanic there, because normally in these massive mega mine deals, the operator wants a trapdoor, right?
Yes, exactly. Usually, if you are a massive miner and you sell a stream to finance a build, you staple a clause to the contract. It basically says, if metal prices explode or if we find way more ore than we modeled, we can buy back half of this stream in 10 years for a set penalty fee.
Right. They cap the streamer's upside so they don't look foolish to their shareholders a decade later.
Precisely. But here, the president, Wheaton Precious, confirmed there is no buyback. None at all. The dropdown is limited to 1/3 eventually, but otherwise Wheaton gets full exposure to silver prices for the entire remaining life of the mine, which they project to be 40 to 60 years.
Wow. 40 years of uncapped silver from a single contract?
Yep,
But step back for a second. If you are BHP, you are the largest mining company on Earth. You have access to capital. Why on earth would you permanently hand over a multi-billion-dollar upside just for upfront cash?
that is the absolute best part of this transcript. It is not because the mine is dying. It is logistics, literally just moving dirt.
Wait, dirt?
Yep, dirt. So Antamina has been running for a long time. The ore is still great, but they are running out of physical room to store the waste rock, what management called limitations on tailings capacity. To expand the footprint and keep digging the valuable stuff, BHP has to spend billions of dollars locally just to restructure the earthworks.
That is wild. So it is not even about finding the silver. It is about where to put the garbage rock.
Yeah, pretty much. So instead of funding that massive tailings project out of their own treasury and taking all that local execution risk, BHP just sells the future silver to Wheaton. BHP gets the cash to move the dirt today, and Wheaton gets the actual silver for the next half century without touching a single shovel.
I mean, that is just a gorgeous business model. It's almost parasitic, but in a very, I guess, symbiotic, high finance kind of way.
Symbiotic is definitely the word they would prefer. But look, there's obviously a macro catch here. If commodity prices collapse, that $2 billion in debt suddenly feels a lot heavier to carry.
True. But even then, do they really care? Because their fixed cash cost is under $500 an ounce for gold right now. Silver has similar extreme leverage. If spot prices drop, their margins compress, sure, but they're nowhere near going underwater.
No, they're not. Hadali made a great point on this during the Q&A. He said even if commodity prices went down by 50% from here, Wheaton's total volume production is scaling up so aggressively over the next few years that their cash flow basically stays stable. They have a 50% increase in production essentially locked in by 2030. They're functionally immune to a normal cyclical drawdown at this point.
Okay, so they have engineered a machine that prints money if prices go up and merely survives incredibly well if prices go down.
Yeah, the math is fairly bulletproof.
Which kind of brings us to the broader picture. If the setup is this flawless right now, and legendary CEO Randy Smallwood is taking his final bow at the end of the month, where does this leave them heading into next quarter?
It leaves them in a, slightly weird spot for Q1, honestly. Randy Smallwood hands the keys to Wheaton Precious on March 31st, and short-term, next quarter is probably going to look a bit weak on the headline.
Right, because of that inventory flush we talked about earlier.
Exactly. Q4 had that freak delivery from Salobo, so Q1 sales volume artificially drops as those transit times go back to normal. Plus, there is some actual operational friction popping up out there. Artemis Gold just reported an unplanned mill shutdown at Blackwater on March 12th.
Oh, right in the middle of their ramp-up phase. That is awful timing.
Gearbox failure. It takes 8 to 10 days to fix, but it immediately eats into Q1. And then the high-grade Pampacancha pit is fully depleted now, so their Constancia stream is officially forecasting a production decline this year.
Okay, so 2026 is It is really just a pure transition year then. They close the massive Antamina stream, swap CEOs, and basically ride out these short-term hiccups.
Yeah, which is why their full-year guidance of up to 940,000 ounces is heavily backweighted. They are modeling 45% in the first half, 55% in the second.
I mean, Smallwood is stepping down after 15 years by casually dropping a $10 billion operating cash flow forecast on the table. It is kind of the ultimate corporate mic drop.
He really did set the table perfectly. The VP of mining actually noted they forecast a sector-leading growth rate of approximately 50% over the next 5 years, reaching over 1.2 million ounces by 2030. Most operators are just struggling to replace daily depletion. Wheaton is lapping the industry without buying a single dump truck.
Exactly. You really do not need the shovels if you own the right paper. All right, I think we have successfully geeked out on precious metals enough for one episode.
Speak for yourself. I'm going to go look up mining gearbox supply chains.
Okay, taking a quick breath after that one. If you want these episodes to just magically show up for you, go ahead and follow the show. As a quick reminder, we are an AI-generated podcast, which is exactly how we can scan thousands of pages in seconds to find the actual story. We love hearing what you are watching right now, so shoot a ticker request over to earningsunscripted.datamadness.ca or just grab the X link in the show notes. Thanks for hanging out, and we will catch you next time.
See you out there.